Crypto Liquidity Explained, what you need to know. Hi viewers! Have you just wondered the significance of liquidity in crypto? In today's video, we are going to look into Crypto Liquidity Explained and what you need to know more about it. The changing landscape of globalized finance markets. The birth and growth of globalized finance markets has fundamentally changed the way the economy balances itself. Keeping the world economy functioning properly and guaranteeing robust development requires a number of new factors. Liquidity is one such important idea, which has grown in significance as global trade has grown. Initially, it may appear that liquidity is a rather straightforward idea with little bearing on the world economy. Essentially, the fluctuations in liquidity have the potential to affect not just the cryptocurrency sector, but whole nations and possibly global markets. Consequently, if you want to work in this field, it is imperative that you comprehend the nature, advantages, and long-term effects of crypto liquidity. Exploring the concept of liquidity. The idea of liquidity is simple. It is the speed at which marketable assets may be turned into cash. Assume that there are 10 distinct investors and a single market for asset X. Investor A wants to profit fully from all of their investments in asset X. If they do so almost instantly and without making a sizable price concession, the market is very liquid. On the other hand, suppose Investor A posts their assets for trade and receives no response for a long period. Investor A has to give up their desired price quotation or wait to cash in on the asset. Low liquidity in this specific market is indicated by this circumstance. Naturally, given their potential sensitivity to price and aversion to risk, Investor A is less likely to close a contract in these conditions. As a result, the liquidity indicator evaluates the ease of trading on the market, the amount of market players, the demand for certain assets, and the total cash supply all affect how simple the market is. Liquidity impacts are also determined by a wide range of other circumstances, such as important regulatory changes, economic downturns, political upheavals, and wars. Liquidity levels. What you need to know. Liquidity levels, as previously mentioned, impact the health and activity of the financial and business markets. But why, in any case, is this statistic so significant? One important area where modern enterprises have gone digitally is trade. Nearly all of the top businesses in the sector have listed their shares on stock exchanges. Forming a business and going through an IPO is the standard approach of raising money and obtaining sufficient resources to expand rapidly. Trading markets are therefore more important than they have ever been. Nearly all publicly listed companies worldwide, covering most sectors, rely on the performance of stocks, treasury bills, forex, and cryptocurrency exchange markets to determine their profitability. Liquidity is likely the most important statistic for the global economy since it is a fundamental notion for trading marketplaces. Assume the following simplified scenario. A number of political and economic causes are causing liquidity issues in the industry-wide trading market. Because of the volatility and unpredictability of the sector, traders in this specialty have chosen to leave it. There are now half as many players in the trading market as there were previously, which has led to wider spreads, lower turnover, and less transaction volume. Companies in this sector won't be able to issue new shares or profit from the ones that already exist as a result. Their market value will most likely decline, and in certain cases, bankruptcies will follow. Thus, the decrease in liquidity has far-reaching consequences in the trader's room and the global economy. Exploring the complexity of market liquidity ratios. The market liquidity ratio cannot be computed using an easy-to-understand formula. Traders can examine the trading volume, bid-ask spreads, and total turnover rate to measure the liquidity levels in a certain sector. High trading volume typically rises sharply when liquidity is ideal, demonstrating the number of active traders and the seamless stability of prices. Since there are many suppliers and buyers in the market, it is much simpler to match supply and demand in terms of pricing, and bid-ask spreads are often lower in this situation. In high liquidity conditions, the turnover rate will also rise, indicating that the same tradable assets will change hands several times in a single trading session. This growth in activity shows that there are many participants in the market who actively use a variety of methods and carry them out without encountering any difficulties. When these three criteria reach greater levels, almost any industry will develop effortlessly and organically. Liquidity, a vital indicator of success. Liquidity, as was said, is an important indicator for any global trade industry. But because different industries have different levels of liquidity, their significance varies. For example, significant liquidity issues are uncommon in the currency market surrounding well-known and established currencies. For many years, the US dollar, the euro, and the British pound have dominated the market, and there are rarely or never any liquidity issues in their respective currency markets. In this area, large financial institutions often serve as market makers, offering competitive rates and small spreads to the industry. Conversely, it is far more difficult to raise liquidity to ideal levels in emerging markets with less seasoned leaders and market makers. The latter is best shown by the state of the cryptocurrency market, where liquidity has been a well-known problem since the industry's start. Although blockchain technology brought many beneficial and novel ideas to the market, its most well-known product, Bitcoin, has had difficulty finding a place on the market. The crypto sector, 14 years after Bitcoin's invention, is largely speculative, influenced by speculative customer demand. This can lead to price spikes and economic downturns. Liquidity is crucial in the crypto sector, as it is less abundant than fiat and stocks. Central banks are not interested in providing liquidity, so non-bank liquidity providers must bear the brunt. The crypto industry must monitor liquidity levels to avoid major financial downturns. Even if the significance of liquidity in the cryptocurrency space was examined in the previous section, it may still be difficult to see how liquidity impacts this sector. Thus, let us envision two distinct situations centered on Coin X. In the first case, there is a lot of liquidity for Crypto X. The liquidity levels of Crypto X are fast declining in the second one. What then would be the distinction between the two circumstances? In a high liquidity scenario, the market benefits from active traders, liquidity providers, and businesses adopting Crypto X as their payment option. However, in a low liquidity scenario, these benefits are lost, leading to increased risks and fewer price matches. This adverse chain reaction can lead to companies going bankrupt, traders exiting the market, and currency losing its value. Liquidity crises have occurred more often than expected, both in crypto and conventional trading markets. The 2008 housing bubble in the USA is an example of a liquidity crisis that can have global ripple effects, as banks sold collateralized debt obligations to the public. The crypto market's growth relies on avoiding volatility by introducing intrinsic value and increasing user adoption for global payments. Current trends, such as smart contracts and cross-border payments using crypto assets, are expected to lead to a less volatile state and increased liquidity levels. The success of the crypto market depends on maintaining current trends and prioritizing intrinsic value over hype. Thank you for watching this video. If you liked the video, don't forget to subscribe our channel and leave a comment in the comment section below.